Hey everybody, Real Estate Ninja here. We're going to talk about the banks. Got a couple of really good stories. Actually, we have everything from bank stocks soaring despite record bailout facility right now for the Fed. We're going to talk about bank loan volume sinking. It's not good as deposits are rising, which is good as deposits rise. Then we're going to talk about the number of Americans upside down in auto loans. Very important because it's going to bode bad for the bank. So real quick, before I leave, I just got to do a little shout out. Check this out. Show you where I am right now. Missoula, Montana. Beautiful snow on the rooftops. Missoula Fire Department, go out there crushing it right now. My hat's off to them. And if any of you watched the game last night, the Grizzlies versus North Dakota, holy cow, that was an awesome game. All right, now, real quick, we're gonna dive right into this. Bank stocks. Bank stocks are soaring right now. I know it sounds crazy. In the middle, and I gotta tell you, this is something that really baffles most people because everybody pays attention to price. They're like, price of stocks are up, economy good. That's not always the case. I've told you before, when we go from inflation to hyperinflation, low inflation to higher inflation to hyperinflation, every stock market goes up, but it never goes up alongside of necessities, right? Food and energy. So there are some winners to be made, but it never stays up with the cost of living, right? There's always losers. And then when the top just snaps and breaks, everybody's piled in and it's just a bloodbath, right? Very similar to what we saw in 2007, but actually it's not similar because we didn't have the inflation that we have now. So as banks are crashing, things are going bad. The FDIC has taken over some banks. They're consolidating like crazy. They're laying tons of people off. Bank stocks are going up. Why? Because investors are going, hey, you don't got to pay those pesky humans, you're going to make more profits. And so the other thing that you need to see, the other side of that coin, is that when you lay people off, it's because you're not making a lot of money. Okay, and eventually all of that comes back to bite you. And we're seeing companies like JP Morgan, and I think Wells Fargo has made announcements that the sheer amount of money they're about to put out just in, the cost of laying people off is going to bite them in the butt. So let's talk about this. It says bank stocks soar despite record high usage of Fed bailout facility. MM funds see the first outflow in money market funds see the first outflow in 7 weeks. After surging to new record highs, money market funds saw outflows last week, the first outflow in 7 weeks of $11.5 billion. Now, really, if you look at it, and I'll show it to you right here, that's really not that big of a deal, okay? Here's the chart. You can see the little circle right there is the outflow, okay? The trend is obviously up for money market funds. Why? Because people are searching for yield. They need to get some type of return on their money to hopefully keep up with inflation, but we all know that is not going to happen. It says that we also saw the first aggregate outflow from money market funds in 7 weeks. And so with that in mind, we shift attention to bank balance sheets as the Fed attempts to manufacture data on loans and deposits to ensure that we don't panic. Now, you saw that video the other day that I gave about the FDIC, the leaked tape, and I'm sure they don't tape those meetings anymore, or they're keeping tighter hands on it. But you heard the laughs when people are, the people in the FDIC are sitting there with all these attorneys and powerful individuals in our country's banking system talking about how the banks are collapsing and don't let them know or they're going to panic, and they don't need to know. And there's giggling going on. They don't look at us like equals. They look at us as peasants. It says on a seasonally adjusted basis, total bank deposits rose by 28.4 billion after falling 54 billion from the prior week. Now, when you see this chart that I show you, I want you to understand, first, the green arrow is going to show you what I'm talking about, right? Do you really think that's that big of a deal? Green arrow? No. But I want you to look at up here. When you say money is being pulled out at a rapid pace, deposits out of our bank account, it is an understatement. Okay. So moving on, it says, well, I totally deleted that story. Great, and that's live. That figures. All right, I deleted 2 stories. Jeez, oh, Ninja got a fat thumb. Stand by. Watch this. Let's see how fast we can do this. Oh gosh, this is so awkward. I want to come up with something, but my mind just went blank too. We're going to get to the story about the car loans. I think that's very, very important. And I can't find it. All right, that's what happens in your life. Yeah. Let's talk about car loans. Number of Americans in upside down auto loans continue to worsen. Consumers face increasing financial difficulties due to elevated inflation, a generational high in interest rates, maxed out credit cards, lack of personal savings, and 2 years of negative real wage growth amid the mounting failures of Bidenomics. The latest distress is that the number of Americans in upside down auto loans has reached the highest level since 2020. According to automotive research firm Edmunds.com, the number of Americans with auto loans that are underwater or negative in equity in November reached an average of $6,054, which was the highest level since April of 2020. That doesn't even make any sense. Oh, that's the negative equity. I'm just thinking about how I just lost those two stories I wanted to share with you. So $6,054 dollars. That's the amount of negative equity right now. So to give you an idea, now again, it's really interesting that the last top happened in March of 2020. Car owners that were underwater by the most since 2020. Because if you think back, what was going on in March of 2020? Let me show you this chart. Try not to delete it again. All right, look at this chart right here. So that was the last top, March of 2020. You're like, well, wait a minute. If you were underwater in auto loans, in auto, values, that means things were going bad before everything got shut down. I've been talking about this for quite some time. We were already crashing in late 2019. Banks were not lending to each other. It was really ugly. And the government needed something to switch up, to be able to inject money into the economy. Identical to what happened with the Spanish flu, 1918, and the subsequent depression of 1920. So right now, we have just hit that same peak, that same threshold. It's very, very important that people realize what's happening there. So it says it's a precarious spot for many Americans, and this is going to hurt the banks, seriously, because the banks are exposed to all that debt, right? They're not paying on. They have negative equity, and more people are not paying on their payments, which means loans are going to constrict. And that's one of the stories I lost, was loans are constricting. And as these loans constrict, banks give out less money. What happens is we have a little bit of a panic. And at one point, we have a little bit of a blow off top in price. But then when there's no buyers, like we're seeing in the, I found the story, like we're seeing in the real estate market, prices come down because the people that need to sell their homes or they need to sell cars, whatever, they are still going to try and sell those cars. How do they do that? They lower the price. That's the low-hanging fruit. So in the car story, and then we're going to get to the bank loan volumes, it says it's a precarious place or a spot for many Americans coming after a twin surge in car buying and interest rates that have strained finances and fueled an uptick in automotive repossessions. Bloomberg explained, adding the average rate for a new car loan is 7.4% and 11.6% for a used car. It says earlier this year, when discussing the perfect storm hitting the U.S. auto market, we showed that according to Fitch, more Americans can't afford their car payments than during the peak of the financial crisis. And remember, during the peak of the financial crisis, it's insane where we are now as compared to the great financial crisis, the Great Recession, 2008. And you're seeing all these valuations, these numbers, and yet the masses still don't get it. And this is the easiest thing to be able to show you why I know there's going to be a crash coming. When? No clue. Zero clue. But that broken clock, it's right twice. What do you want to be? Do you want to be right twice or never right at all? You see, that's the thing. People are out there making some money in stock gains. They watch their 401ks go on. They're like, yes, I'm a millionaire on paper. I knew a lot of millionaires on paper. in 2006. And then it was gone fast. Almost seems overnight, but it wasn't. It was like a 1.5 to 2 year process. And we're at that spot again. It says the average new car loan has reached a record high of $40,000, which was to be expected after the latest consumer report from the Fed. Revolving credit shows the highest interest rates have bogged down student and auto loans. In other words, the consumer is stretched. We're in a situation where, combined with the cost of vehicles being so high and the interest rates being so historically high, that's not true. You have a lot of people who are in bad car loans. Joseph Yoon, consumer insights analyst for Edmunds, told Bloomberg. To Yoon's point, the percentage of subprime auto borrowers at least 60 days past due in September topped 6.1%, which is the highest ever. Let me repeat that. When your family and friends are telling you you're crazy because you're saying, hey, the market's going to crash, this is not good, get ready. Like, please, they're idiots. Let's just call them out. You're an idiot if you don't get it. Okay, so this is Americans struggling to afford car payments. The percentage of borrowers at least 60 days late on their car loans is at a record high. And this chart goes back to 1994. Look at it. Isn't it beautiful? Now, think about this. Look at 2010, 2008, 2010. Not even that high. Wow. I gotta be honest with you. It makes me feel all tingly inside. All right, so we already know that the banks, this is all bad news to the banks, right? They're gonna start loan volumes. Check this out. Story out of Zero Hedge. Bank loan volumes shrink as deposits rise, but trouble is brewing. Okay, so before I even read the story, let me think. Bank loan volumes shrink. Banks make money loaning money, charging fees and charging interest. Deposits go up. Well, that's really great, unless you can't do anything with these deposits, i.e. making loans. All right, so here we go. Yesterday, we discovered that regional bank shares have been soaring up towards pre-Silicon Valley Bank levels, despite yet another increase to a new record high in the usage of the Fed's bank bailout facility, which is now at $124 billion. I just want to remind you, we're actually in a crisis. If anyone tells you otherwise, they're an idiot. And I only say idiot because they're an idiot, because the Federal Reserve is bailing out banks. They are in the middle of providing liquidity because the banks are on a lifeline. I don't know how better to say that. People are like, banks aren't gonna crash, economy's not gonna crash. Copy. And you know what's really cool? This is really cool. Most people don't understand this small fundamental when it comes to governments and banking systems. They always keep the lifeline going until they go, yeah, it's enough. See, last time they went, yeah, it's enough with Lehman Brothers. And even Lehman Brothers was surprised. They're like, bailing out. FDIC's coming in. Don't worry. Washington will fix you. All this stuff. Bear Stearns, well, you're an investment house. You close down. And all of a sudden, Lehman Brothers, yeah, this one we're going to let go. And that was it. And what they do, and what most people don't understand, is these people that are very rich and well off, and I mean well off because they're rich and they work their butt off to get there and they understand capital markets and how all this stuff works, world banking systems and all that stuff. While they're doing these little patches to fix things, like this is a big patch, this is like a gusher, they're getting out of the markets. And it doesn't happen overnight. So it says here, obviously, we're got some issues. It says here, we also saw that the first aggregate outflow from money market funds in 7 weeks. And so with all that in mind, we shift attention to bank balance sheets as the Fed attempts to manufacture data on loans and deposits to ensure we don't panic. Remember I showed you that video the other day about the FDIC saying we don't want the public to panic because they really don't need to know what's going on with the banking crisis. This is a real video. Type 1 if you saw that. Type 2 if you didn't. If there's a lot of 2s, I'll play it again. I might not be able to find it actually. Don't type 2. Okay, point being is this. On a seasonally adjusted basis, total bank deposits rose by $28.4 billion after falling or 54 billion the prior week. So what does that mean? Nothing. It means nothing. Look, look, look. They're saying, oh, bank deposits rose. Who gives a crap? Look how much they fell the week before. See, that's where you got to really look at that data and say, where is the trend? All right, where's the trend? On a seasonally adjusted basis, total bank deposits jumped 65 billion, which was the second weekly increase in a row, to the highest level since the SVB banking crisis. So ever since Silicon Valley Bank collapsed, we still haven't seen the deposits this high. And then even the deposit inflows and money market outflows, the divergence did not improve much. It says here, breaking it out, large banks saw 30 billion seasonally adjusted and 51 billion non-seasonally adjusted deposit inflows, while small banks saw 6.1 billion seasonally adjusted and 15.3 billion non-seasonally adjusted inflows. Over the past 6 weeks, domestic banks added 245 billion in deposits and lost 13 billion in deposits. So those are gaining. But rather oddly, on the other side of the ledger, amid these surging deposits this week, loan volumes shrank for both large and small banks. All right, so here, let me show you this chart. Because when you're looking at it, the worst months for the loans, or the worst weeks this year, were, what is it, the first and second week of November, right? And then they went positive, and now look, they're shrinking again. All right? Now, is this seasonally? It could be. If you look back in December, last week of December last year, it was down. So that could be. Not a lot of people buying, but you've got to cut through the minutia. Serious, it says right here, as the red line shows, without the Fed's help, because they're bailing out the banks right now, they're keeping them alive. The crisis is back. All of which makes us wonder, just thinking out loud that we are setting up for another banking crisis in March. And as this reverse repo, and that is the amount of money that the Federal Reserve is putting into these banks in the form of liquidity, is shrinking. See how it shrinks? All right? And the Fed always does this. They try and normalize these markets. As it gets lower and lower, if banks still need that much to keep going, or we see any other little crisis in credit, then they're going to have to re-inject a bunch of money. Or there's going to be a couple banks that all of a sudden topple. The question is, which ones? Now, again, I have to tell you, this is why I have multiple bank accounts. Life still goes on. And I always keep my money in accounts that are under the $250,000 threshold. And I think it's very important for people to know that because, and I have some accounts that are strictly savings accounts. They're not tied to anything. Because you want to be diversified, okay? I think we're going to see some interesting stuff this year. There's no doubt about it, but I just want to bring you the news, and I hope you got something out of this. Sorry, I deleted one of the stories in the middle of it. I'm going to go over to the Economic Ninja channel now because there's a big layoff happening in shipping, and shipping is, and I can't believe it. I think YouTube literally just let that channel get over 440,000, which is a pretty big threshold. Kites confirms 15% cut in global workforce. As shipping keeps grinding to a halt, you have to realize that's the real economy. That's us buying and selling goods. That's real economy. Everything else, it just flows through slowly to the rest of the system until it turns into something really bad. So I'm going to go over right now and do a live stream on Economic Ninja. Thank you so much for watching here. Real Estate Ninja, holy cow, I got it right first time, is out. I can't believe I did that.